Welcome back, everyone. Today we are breaking down gold on the 1-hour time frame, and we have a very important fundamental event happening today. The US April CPI data is dropping at 8:30 a.m. Eastern Time. So in this video, I am going to walk you through my full technical setup on gold, explain what the CPI number means, what the market is expecting, and how gold is most likely going to react. Let's get straight into it. Looking at gold on the 1-hour chart, the first thing that stands out is this weekly bearish rejection zone, sitting between roughly 4,750 and 4,770. This is a significant supply area on the higher time frame, and price has been respecting it very well. Now, if you look at what just happened, price pushed up through this zone and spiked all the way up to around 4,780. That area above the zone is where we have a liquidity pocket. Smart money calls these dollar signs, essentially buy stops sitting above a key level. Price ran those stops, grabbed that liquidity, and then immediately showed rejection. That spike up, followed by a sharp reversal, is a classic liquidity grab. The big players needed buyers at that high to fill their sell orders, and now that they have what they wanted, the direction is down. So my full bearish scenario plays out like this. I expect a small bounce or a minor recovery right now, maybe up to the 4,720 area. This would be a fake-out move to trap any late buyers who think the dip is over. Once that small bounce is complete, I am expecting price to break down, first targeting the liquidity pool sitting below at around 4,650. That is another zone where sell stops are resting, pending orders from traders who went long. After that liquidity is swept, the real move comes into play. The 0.618 Fibonacci retracement is sitting at approximately 4,600, which aligns as a strong confluence level. And the full target, the final destination based on this setup, is down at the lower demand zone, around 4,556 to 4,570. That is a significant move to the downside, and the technicals are fully supporting the bearish case. The structure, the rejection zone, the liquidity grab, everything is pointing south right now. CPI breakdown. Now let us talk about the fundamental side, because this is where today gets interesting. The U.S. Bureau of Labor Statistics is releasing the Consumer Price Index for April 2026 today, Tuesday, May 12th at 8:30 a.m. Eastern Time. U.S. Bureau of Labor Statistics. To understand why this matters, let us look at where we are coming from. In March 2026, the annual inflation rate jumped sharply to 3.3%, marking the highest level since May 2024, up from 2.4% in February. The monthly increase came in at 0.9%, the largest single-month jump since June 2022, and it was driven almost entirely by a massive surge in energy prices, specifically gasoline, which jumped over 21% in a single month. Trading economics. The reason for that energy shock is the ongoing conflict between the United States and Iran. Since the US and Israel strikes on Iran in late February, Brent crude surged more than 55%, from around $72 per barrel to a peak near $126 in late April, before retreating to around $103. That war premium is still very much priced into oil, which means energy is not going away anytime soon. So what is the market expecting for today's April CPI print? Headline CPI is forecast to rise approximately 0.59% on a monthly basis in April, after the 0.90% jump in March. On a year-over-year basis, the forecast is 3.7%, up from 3.3% in March. Core CPI, which strips out food and energy, is expected to rise 0.30% month-over-month and 2.7% year-over-year. Morningstar. Barclays economist Pooja Sriram puts it this way. They are forecasting headline inflation at 0.55% month-over-month and 3.7% year-over-year, with core inflation at 0.34% month-over-month and 2.7% year-over-year. The April report will also include a one-off adjustment to rent data that was missed during the government shutdown last fall, which adds an extra upward push to core. Kiplinger. Some more aggressive forecasts are even penciling in annual CPI rising to 3.8%, with Bank of America and JP Morgan both suggesting that rate cuts in 2026 are essentially off the table, with JP Morgan believing inflation will stay above 3% until early 2027, regardless of how the Middle East situation develops. How gold reacts to CPI. Two scenarios. Now here's the key question. How does gold react to today's number? If core CPI comes in hotter than expected, that reinforces hawkish bets surrounding the Federal Reserve, lifting the US dollar at the expense of gold. On the other hand, if inflation comes in softer than expected, gold could receive a boost. FX Street. The Federal Reserve is currently holding rates at 3.50 to 3.75%. The CME FedWatch tool shows essentially zero probability of a rate cut in the near term, and only around 30% probability of even one cut by December 2026. When rate cuts are priced out, the real yield on government bonds stays elevated, which creates a meaningful opportunity cost for holding non-yielding assets like gold.
So here is how I see it playing out. If April CPI comes in at or above the 3.7% expectation, the dollar strengthens, yields stay elevated, and gold faces significant downside pressure. That aligns perfectly with my bearish chart setup. The technical rejection from the weekly bearish zone combined with a hot CPI print would be a strong confirmation to push gold toward those lower targets. If CPI surprises to the downside, say it prints at 3.4 or 3.5%, gold might get a short-term spike upward. But I want to be clear, even in that scenario, the technical structure on this chart is bearish. Any bounce from a softer CPI print would most likely be the fake-out move I already mapped out on the chart, price pushing back up briefly before continuing the overall downside move. The broader picture is not changing. Inflation is staying elevated well above the Fed's 2% target. Rate cuts are not coming. The dollar remains supported, and gold has already shown its hand by failing at that weekly bearish rejection zone. Conclusion. To summarize, my gold analysis is bearish on the 1-hour time frame. Price grabbed liquidity above the weekly rejection zone, showed a strong reversal, and is now setting up for a move down toward the 4650 liquidity level, then the 0.618 Fibonacci at 4600, and ultimately the full target at the lower demand zone around 4560 to 4570. Today's CPI data is the catalyst. A hot print confirms the sell. Even a softer print only gives a temporary bounce before the downtrend resumes. As always, this is my analysis and not financial advice. Manage your risk, use your stop losses, and trade what you see on the chart, not what you hope will happen. If this video helped you, drop a like, leave a comment with your own gold view, and subscribe so you never miss an analysis. I will see you in the next one.